If you're an Australian planning to log on to MyGov and lodge your tax return, the literal second the clock strikes midnight on July 1st, stop. Seriously, just don't do it. Look, I get it. You want your tax refund back fast. Times are incredibly tough. Interest rates are sitting at a brutal 4.35%. Cost of living is out of control. And having that extra cash in your account sounds like an absolute lifesaver right now. But by clicking send that early, you are stepping right into an automated ATO audit trap. See, this year, the Australian Taxation Office has heavily upgraded its systems. We are talking massive AI data matching programs that automatically cross-reference your claims against your employers, your banks, your crypto exchanges, and your share brokers. If you file early, before that third-party data is actually pre-filled into your account, your return gets flagged for a manual review. And that means your refund doesn't just get delayed, it triggers an unwanted audit. Today, we are breaking down the 5 massive loopholes and deduction strategies that the ATO is watching with a hawk's eye this month. If you use any of these, you need to know the exact rules so you get your money without getting a penalty notice from a tax auditor. Let's dive straight in. First up is the work-from-home deduction. Since remote work is completely normal now, the ATO expects to see home office claims. But here is the major trap that is going to catch thousands of Aussies out this month: the double dip. You have 2 main ways to claim working from home: the fixed rate method or the actual cost method. Now, the fixed rate method is super popular because it's easy. For this current financial year, that rate sits at 70 cents per hour. It covers your electricity, your gas, your home internet, your phone usage, and your office stationery all in one single basket. You just multiply your total hours worked by 0.7 and boom, there's your deduction. But here is what the ATO is actively hunting down. People are claiming that 70 cents per hour, but then they are also trying to write off their home internet bill or their mobile phone data plan separately on top of it. That is an instant automated red flag. The system flags that double dip immediately because the 70 cent rate already includes your phone and internet. You cannot break them out. If you want to claim a brand new laptop or an ergonomic office chair on top of that fixed rate, you can do that, but only if the item cost more than $300 and you depreciate it over time. And please, keep a diary. The ATO requires a contemporaneous record of every single hour you worked from home. A rough estimate or a generic "I work 40 hours a week" guess will get your entire claim completely wiped out if they ask for proof. Topic number 2 is a massive one for tradespeople, healthcare workers, and anyone using their personal car for work. It's the motor vehicle claim. There is a huge myth floating around Australian staff rooms that you can automatically claim up to 5,000 kilometres under the cents per kilometre method without showing any receipts or paperwork. People treat it like a free bonus tax deduction. Let me be entirely clear. This is a complete myth. The ATO does not require fuel receipts for the cents per km method, but they absolutely do require you to prove how you calculated those kilometres. You can't just guess 4,900 kilometres because it's under the limit. You need to show a diary log of your trips, detailing the date, the destination, and the specific work purpose of that travel. And if you are driving a dual cab ute, which are absolutely everywhere across Australia right now, the ATO is running a heavily targeted crackdown on them. They know that a lot of people buy these heavy vehicles claiming they are strictly for business, but use them to tow boats on the weekend or drive the kids to school. If your employer provides you with a vehicle, or if you are claiming 100% business use on a personal vehicle without a bulletproof, up-to-date 1-2 week logbook, you are playing tax roulette. Take the time this week to tidy up your logbook before June 30 hits. Now we are moving into the premium territory. If you own an investment property, listen up very carefully, because this is exactly where the ATO recovers billions in lost revenue. Australia is a nation obsessed with property, and negative gearing is a completely legal, highly effective way to reduce your taxable income. But the ATO's data matching systems are now directly linked to short-term rental platforms like Airbnb and Stays, as well as state land tax registries and banks. The biggest loophole they're closing right now is what I call the holiday home sham. This happens when someone owns a nice holiday house down on the coast or up in the mountains. They claim it's an investment property and write off massive mortgage interest payments and maintenance costs against their high salary. But when the ATO looks at the platform booking history, the property was only listed for rent during the cold, off-peak months at an absurdly high price that no one would ever pay, while the owners used it themselves all through the peak summer holiday. To claim property deductions, the house must be genuinely available for rent at market rates. If you block out the peak periods for your family, or if you rent it to your mates at a massive discount, you can only claim deductions proportional to the time it was actually rented to paying strangers. The ATO is actively rejecting these inflated claims and issuing massive back tax penalties to property investors this season. This next one is specifically for the small business owners, contractors, tradies, and sole traders out there. If you operate an ABN, you need to understand the concept of first use. There was a massive announcement recently in the federal budget. The $20,000 instant asset write-off has officially been made a permanent fixture of the Australian tax system. This is incredible news for small business cash flow because it ends years of temporary, last-minute extensions. It means you can buy tools, computers, or heavy machinery under 20 grand and deduct the full cost straight away rather than depreciating it over several years. But here is the major June 30 catch that trips up almost everyone. The asset cannot just be purchased or invoiced. It must be first used or installed ready for use before midnight on June 30th. If you buy a $15,000 piece of equipment on June 28th, pay for it in full and get the digital invoice, but the delivery truck doesn't drop it off at your workshop until July 3rd. You cannot claim it on this year's tax return. It pushes entirely into the next financial year. Don't let a supplier trick you into thinking an invoice date is enough to satisfy the tax office. If it's not sitting in your possession, turned on, and ready to do work before June 30, it simply doesn't count for this year. Finally, loophole number 5 is the hidden income trap. If you have an Uber side hustle, an eBay or Shopify store, an Airbnb, or you've been flipping crypto on Australian exchanges, listen up. The ATO's data matching systems are completely automated with these platforms now. They know exactly how much cash went into your account before you even log in. But here is the smart strategy to offset it. Because of recent budget updates, including the new $250 working Australians tax offset, structuring your deductions this month is absolutely vital to maximizing your cash flow. If you made money on a side hustle, don't try to hide it. Instead, legally maximize your expenses before June 30. You can prepay your professional association memberships, renew your work subscriptions, or buy required protective gear right now. By bringing those expenses forward into June, you get the immediate deduction to offset that side income, keeping more money in your pocket. And remember, the ATO is even tracking online marketplace flipping. If you're running a side business, keep clean records, declare the income, and use legitimate expenses to bring that taxable balance down safely. Tax time in Australia doesn't have to be terrifying. It just requires you to be smart, keep your logbooks tight, and understand what the systems are looking for so you can keep what is rightfully yours. Now, if you want to make sure you aren't legally leaving thousands of dollars on the table with these new property and investment rules, click on this next video right here, where I map out the ultimate step-by-step wealth-building checklist before the June 30 deadline hits. Drop a comment below if you have a question about your specific setup. See you over there.